Welcome everyone. Just going to leave it a few minutes. Just wait for everybody else to join. There's normally a few people that join after the starting time, so we'll just give it a few more minutes. Hello everyone. Just going to give it another minute or so, just for any further people coming in just after 1 o'clock, and then we'll start.
Thank you.
Okay, I think we've probably got as many as we're going to get. If anybody else joins late, I'll just have to let them in as we go along. So everybody, welcome to Mastering Inheritance Tax Strategies for Preserving Your Family's Wealth. My name is Andy Southgate, and I'm the Senior Chartered Financial Planner for Drewberry. I have 20 years experience in the wealth management profession, including 8 years spent in the Iberian Peninsula advising high net worth and ultra high net worth individuals, families, and trusts. So hang on, we've got somebody else coming in. So Drewberry is a company that's based in both London and Brighton. However, as we do the vast majority of our work virtually, we have clients all over the UK, including as far as the north of Scotland. We have a variety of specialisms, including corporate work and insurance. However, I work for the wealth planning side of the business, and today we're going to be talking specifically about inheritance tax and how you can plan to legally avoid or reduce. Oops, sorry, got someone coming in. Hold on 1 second, guys. And how you can plan to legally avoid or reduce the amount payable on your estate. We'll just go through quickly what we'll cover today. So there's just going to be an explanation of inheritance tax, how it's a very complicated regime, the process of claiming inheritance tax reliefs and exemptions, the main exemptions and reliefs available, how to mitigate or eliminate inheritance tax. We'll talk about gifts and potentially exempt transfers, trusts, business property relief, insuring an inheritance tax liability, and how we at Drewberry can help you. Finally, at the end, there'll be a Q&A, and at the bottom of the screen, you'll see an activities tab on the bottom right. If you click on that and click on Q&A, you'll be able to ask me any questions that you wish to ask. So I'm just going to turn my camera off because I've got a bit of a bandwidth problem here, so apologies. I'll turn it back on if it gets better. In 1986, Roy Jenkins, who was formerly Chancellor of the Exchequer, stated that inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. Nigel Lawson, also a Chancellor, made a similar quote: "You can either do nothing and volunteer to pay it, or you can take steps to avoid it." These quotes have gone on to become famous in financial circles, and whilst they're sound bites, they do highlight the fact that even today, inheritance tax is legally avoidable, and with careful planning, yet most people do not do so. The key here is to plan in advance. Leaving matters late is, as we'll see, not an option when it comes to mitigating inheritance tax. So inheritance tax is the tax on the estate of someone who has died, including all property, possessions, and money. The standard inheritance tax rate is 40%. It's only charged on the part of your estate that's above the tax-free threshold, which is currently £325,000. That's a very basic explanation, and as we move through, we'll add further layers of complexity so that you'll see just how much of a minefield this area is. Firstly, let's look at some of the rates applicable. So as per my previous comment, the rate charged on death is currently 40% after any thresholds are taken into account. To give a simple example, if your estate is worth £1 million as a single person and you have an allowance available of £325,000, then the amount chargeable to inheritance tax would be £675,000 at 40%. And that gives you a tax bill of £270,000 that's payable by the estate. And that's before any money is released to the beneficiaries of the estate. So I'll repeat that. Inheritance tax must be paid within 6 months before any money or assets can be released to those inheriting a legacy. After the 6-month period, interest will accrue. There is also something called a lifetime rate applicable in certain circumstances. So should one gift money into a discretionary trust above the £325,000 threshold, an amount of 20% will be charged on the excess. To provide a simple example again, if a gift into trust was made of £500,000, then after the allowance of £325,000 has been used, the difference of £175k would be taxable at 20%, giving an immediate liability of £35,000. So more on this later when we talk about trusts. Now let's look at some statistics. So the 325,000 threshold for individuals was set in 2009, and Jeremy Hunt has now frozen this until 2028. The allowance will therefore have remained the same for almost 2 decades. What does this mean? Well, if that threshold had risen in line with CPI inflation since its inception in 2009, it would now be worth £464,643, but it isn't, it stayed the same. And this is known as a stealth tax. These freezes will drag more people into the inheritance tax net. Analysis by accountancy firm RSM reveals that 10,000 more families could end up paying inheritance tax. The value of their estates will rise, however, the threshold will remain the same, meaning families will have to shell out a larger chunk of their money, especially as inflation in the UK hits a 41-year high of 11.1%. According to the wealth manager Quilter, an extra £1 billion in inheritance tax could be paid from April 2026 to 2028. And with more people squeezed financially, you're likely to see a rise in giving while living. This is lifetime giving to loved ones, particularly to adult children who are struggling to get by in the cost of living crisis. The extended freeze on thresholds means people will need to seek advice more than ever in order to ensure that their family's wealth is protected and ensure it is distributed in line with their wishes. It's also worth noting that inheritance tax receipts received by HMRC during the financial year 2021 to 22 were 6.1 billion, which was an increase of 14% or 729 million from the year prior. The good news is you can plan to avoid this, and more on that as we move through the presentation. I won't talk too much on this slide other than to say it's very, very clear from the chart if you have a look at it, and the chart's from HMRC, by the way, that inheritance tax receipts have been on the rise substantially, apart from around the global financial crisis of 2007, 2008, where they actually decreased for a while. because asset prices went through the floor. Inheritance tax is an extremely complicated tax. At the most recent count we performed, and this may be slightly out of date, there were 94 reliefs and exemptions available under the inheritance tax legislation. And this makes it the tax with by far the most reliefs and exemptions available. So to give you an idea of the scope of this, I've listed some of them here. I won't go through them all, but you can see things like heritage property relief, which includes works of art, scientific collections, stately homes, and so on. Things like death on active duty relief, which is for service personnel, ambulance drivers, and so on that die in the line of duty. We've also got things on there like quite obscure things like gifts for national purposes exemptions. And the above is just the start. The point that I'm making here is that inheritance tax is extremely complex and should not be navigated alone. It's likely you'll need both financial advice and, most likely, a well-qualified and experienced solicitor, at the very least, to ensure your affairs are in order and your estate is distributed in line with your wishes. So there are some commonly encountered reliefs and exemptions available that many people will end up using, and I'll talk through them now. So firstly, there's a nil rate band, as I've mentioned earlier. That's £325,000 per person and can be transferred between spouses with no tax being owed. There's also the residence nil rate band, which is £175,000, and this is a relief that is automatically applied if the estate qualifies and is related to the inheritance of a main home. The main home must pass to a lineal descendant. This can include children, grandchildren, stepchildren, and foster children. There's no definition provided as to what constitutes a main home. This is decided by the facts of each individual case and can cause huge confusion. For example, even if a person owns a property, then leaves that property and rents it out, it can still be considered a main home for the purposes of this allowance. The residence nil rate band also includes something called tapering, and this applies when an estate is valued above £2 million. So for every £2 that an estate goes above £2 million, £1 of the allowance is lost. For example, should an estate go over by £100,000, then 50k of the allowance would be lost. This can, of course, reduce to zero should the estate be large enough. Now, everyone can gift up to £3,000 per annum to anyone they choose, and this will be immediately outside their estate. You can also give as many small gifts of up to £250 per person as you wish each year, and birthday or Christmas gifts you give from your regular income are exempt from inheritance tax. You can also make regular payments to help with another person's living costs, and there's no limit to how much you can give tax-free, as long as you can afford the payments after meeting your usual living costs, and you pay from your regular monthly income. So they include things like paying rent for your child, paying into a savings account for a child under 18, or giving financial support to an elderly relative. Gifts to charities are also exempt from inheritance tax, whether they are made during your lifetime or on death through a will. Where 10% or more of the net estate is left to charity, the charitable bequest is tax-free, and the remainder of the estate will attract a 10% discount on the rate of inheritance tax paid. Each tax year, you can give a tax-free gift to someone who is getting married or starting a civil partnership, and you can give up to £5,000 to a child, £2,500 to a grandchild or great-grandchild, or £1,000 to any other person. So now let's look at an example and take the scenario of a married couple called Bill and Susan who have 2 children. They own a property worth £500,000 jointly and have other assets also worth £500,000. If Bill were to die, leaving his half entirely to Susan, this would pass to Susan free of any inheritance tax. Were Susan to subsequently pass away, she could then use Bill's allowances plus her own, meaning the entire amount of £1 million could be passed on free of inheritance tax to the children via their will. Let's now look at how you can mitigate inheritance tax using pensions, but first of all, let's cover off what you can put into a pension. So the annual allowance is the maximum amount of pension savings an individual can make each year with the benefit of tax relief. The annual allowance has changed several times since it was introduced in 2006 and is £60,000 currently. It was £40,000 in the last tax year. There's also something called carry forward allowance, and that allows you to make use of any annual allowance that you might not have used during the previous 3 tax years, provided you were a member of a registered pension scheme during the relevant time period. In effect, this gives you the ability to make more contributions than the £60,000 annual allowance if you have the allowances available for the previous 3 tax years. To use carry forward, there are certain conditions that need to be met, and it's beyond the scope of this presentation to go into those conditions. So please do contact us for help if you feel this is something you may benefit from. So why would you use pensions as a way of mitigating inheritance tax? Well, inheritance tax simply doesn't apply when you pass on your pension money. This is because, unlike other investments, your pension isn't part of your taxable estate. That's why it's tax efficient to keep your savings in a pension fund and pass it down to future generations. The money in your pension will not be covered by your will, so you have to tell your provider who you wish to be considered as your beneficiaries. They will take this into account when deciding who to pay your pension savings to. When you place money into a pension, it is immediately outside of your estate. However, because of the relatively, and I stress the word relatively low amount you can place into a pension, being set at £60,000 a year, older people may not have enough time left to fully mitigate tax. However, there are other options, as we shall see later on. So let's look now at potentially exempt transfers. So what are these? These are commonly known as a PET, and it enables an individual to make gifts of unlimited value, which will become exempt from inheritance tax if the individual survives for a period of 7 years. So that, as I said, they only become chargeable if the person who made the gift dies within 7 years of making the transfer, but they are assumed at the outset to be completely exempt, and as a result, no inheritance tax is payable at that time. If somebody does die within the 7-year period, the PET will fail and it becomes a chargeable transfer, and tapering relief will apply at the rates seen on the slide in front of you now. So let's spend some time talking about trusts. First of all, we'll explain what they are and then go into how they can be used to mitigate inheritance tax. I'm just going to try and turn my camera back on and see if it's better than it was earlier. So a trust is a way of managing assets. So that's money, investments, land or buildings for people. There are different types of trusts and they're taxed differently. So trusts involve something called the settler, that's the person who puts assets into a trust, the trustee, which is the person who manages the trust, and the beneficiary, which is the person who benefits from the trust. So what are trusts for? Well, trusts are set up for a number of reasons, and these are not exhaustive, but they include to control and protect family assets, when someone's too young to handle their affairs, when someone cannot handle their affairs because they're incapacitated. They're also there to pass on assets while you're still alive, to pass on assets when you pass away via a will trust or under the rules of intestacy if somebody dies without a will, and that's just for England and Wales. Let's also cover off the 3 main roles in a trust and what each party does. So the settler decides how the assets in a trust should be used. This is usually set out in a document called the trust deed. Sometimes the settler can also benefit from the trust, and this is called a settler interested trust and has special tax rules. Let's look at what the trustees do then. Well, they are the legal owners of the assets in the trust. Their role is to deal with the assets according to the settler's wishes, as set out in the trust deed or their will, also to manage the trust on a day-to-day basis and pay any tax due. They're also there to decide how to invest or to use the trust's assets. Beneficiaries, and there may be more than one beneficiary, for example, your children, and they may benefit from the income only from a trust, for example, from property rentals, the capital only, for example, getting shares held in a trust when they reach a certain age, or both the income and the capital of the trust. Let's move on to something called a chargeable lifetime transfer, or CLT. So a CLT will arise when an individual makes a gift into something called a relevant property trust. A CLT will be subject to an immediate charge to inheritance tax at the rate of 20%, where the value exceeds the nil rate band of £325,000. The liability to inheritance tax rests with the person making the transfer. If that person survives for 7 years from the date of the gift, there will be no further inheritance tax payable, but also there is no refund of any inheritance tax paid at the outset. As we'll see, because of this immediate tax charge, often people will make transfers into trust below the nil rate band of £325,000, which doesn't give an immediate rise to a tax charge. I've put this slide here to illustrate just how common the use of trusts is. As you can see, many billions flow into trusts every single year in the UK. They're a very common planning tool and should definitely be considered by anyone looking to reduce or eliminate their inheritance tax liability. So how can you do this then? Well, in this section, we'll talk more about how the trust can be used to help. This is a complicated area of planning, and financial advice must be sought. So what is a discounted gift trust? So this is a trust-based inheritance tax planning arrangement for those individuals who wish to undertake inheritance tax planning, but who are unable or unwilling to lose full access to their capital. In other words, they'd like to mitigate the tax, but would also like some access to the money invested. Discounted gift trust arrangements are provided by insurance companies in the UK. So why is the term discounted used? Well, the term discounted is used because the value transferred on establishing the trust is more than the amount actually invested. And we'll go through an example in a second, because I understand this is quite complicated if you're hearing it for the first time. This is because the person creating the trust is entitled to ongoing capital repayments. The person creating the trust, that is the settlor, is typically entitled to payments on specified dates at the outset, which will cease when they pass away. Payments from the trustees to the settlor in a discounted gift trust are capital and not income. The value of these future payments that the person creating the trust is entitled to is immediately outside the estate of that person. There is a complicated calculation done by the insurance company, and it's partially based on the life expectancy of the settlor. Any capital growth made by the investment over its course will be outside of the estate. So let's look at an example of this then. Let's look at Michelle, who gifts £100,000 into a discounted trust, and from this she wishes to receive £5,000 per year as an income for the rest of her life. Based on her health, the value of her right to these £5,000 per year payments is deemed to be £40,000 at the outset. In other words, what's happened is the insurance company has assessed her life expectancy and expects her to live for around 8 years. And 8 years multiplied by £5,000 is obviously £40,000. Therefore, £40,000 is the discount and is immediately outside of Michelle's estate. The remaining £60,000 is classed as a gift, and if Michelle dies within 7 years, that £60,000 will come back into her estate for inheritance tax purposes, but not the original £100,000, crucially. If Michelle lives for more than 7 years, the entire gift will not come back into her estate at all, and meanwhile, any investment growth experienced within the trust outside of Michelle's estate. Let's move on to something else called a loan trust, and this involves an individual establishing a trust, but rather than making a gift, the settlor lends money to the trust. The trustees then invest this money, typically into an investment bond, for the benefit of the trust beneficiaries. The settlor can demand repayment of the outstanding loan at any time. This can either be in full or in part. If regular loan repayments are needed, the trustees can repay the loan by withdrawing money from the bond. The settlor is not able to benefit from the trust fund growth in any way. Any fund growth must be used for the benefit of the trust beneficiaries. So who is it appropriate for? It's typically used for individuals who want to start estate planning but don't feel comfortable about giving any of their money away in case they may need it at some point in the future. So creating a loan trust means that any investment growth is immediately outside the estate, and this can help cap the value of assets that are included within an estate. Loan repayments which are spent will further reduce the inheritance tax liability, and any lump sums will also reduce the estate more quickly, provided they're not being used to purchase assets, which of course would form part of the estate on death. Now, this is a very, very simplified explanation, and there are other technical aspects that are beyond the scope of this presentation. You should seek advice from us in this area. Okay then, moving away from trusts and onto something called business relief, which formerly was known as business property relief, and this reduces the value of business property for inheritance tax. It's available on the transfer of business assets during lifetime or on death. To qualify, the business asset must usually have been owned for 2 years prior to the death of the transfer taking place. No inheritance tax is payable on the transfer of qualifying business assets into a trust. Therefore, if selling a business, it is possible to keep business relief by placing the proceeds into a trust and those proceeds will remain outside of the estate provided the 2-year condition has been met. Also, investing in shares which qualify for business relief has become a very popular estate planning option. It has two key benefits over the more traditional gifting route as a means to reduce your estate. The first thing is that the investment will be outside the estate after 2 years rather than the 7 years for gifts. The investor will also retain access to the investment in full and also any dividends that have been paid. So just two key points there. It's only 2 years rather than 7, and the investment will still remain yours, as will any dividends payable. It's also possible for the proceeds of previously held business assets to be reinvested in qualifying shares in this way and still maintain the relief available, provided it's done within 3 years of selling the original business asset. However, these benefits have got to be balanced against the increased investment risk of investing in smaller unlisted companies and the risk that business relief may be withdrawn if in future the business grows. For example, it becomes publicly listed. A holding of shares in an unquoted company generally involves investing in smaller companies, and they are usually not listed on the London Stock Exchange. So things like alternative investment market companies and also enterprise investment schemes. These arrangements may well be suitable for those who wish to get assets outside of their estate very quickly, and an added bonus is that it's possible to obtain a 30% rebate for income tax on those with a high income tax bill through using this method. So it's not just about inheritance tax planning, you can also get a 30% income tax rebate as well, which is very handy in many cases. Okay, so let's move on to insurances and firstly ask the question, well, can you use life insurance to pay inheritance tax? And the answer is yes, you can. You can take out something called a whole of life insurance policy, which remains in force until your death. The idea is to cover the bill that you expect your heirs will have to pay. So you should think of the insurance policy as effectively a gift to your heirs, which to all intents and purposes it is, because they will benefit from having an amount of money that will enable them to pay the bill and receive your legacy intact. So let's say you expect to be £200,000 over the threshold for inheritance tax. You would need a policy that will pay out £80,000 to cover inheritance tax bill in full. That is, of course, 40% over the limit. Now, however, to avoid the proceeds of the policy also incurring inheritance tax, you'll need to write it in trust so that the benefits fall outside your estate. If your family doesn't need your financial support, but you would like to leave them with a lump sum for funeral costs, for example, or to pay off debts, you can also take out something called over 50s life insurance. Finally, if you are giving a loved one a valuable gift in later life, you can also consider taking out a term insurance policy that will cover the inheritance tax bill on the gift should you die within 7 years. Again, it would have to be written in trust to be used this way. And either way, it's definitely worth speaking with us at Drewberry to ensure you receive the correct advice. Finally then, before we move on to Q&A, how are we actually able to help you with any of this stuff? We've been through a lot on this webinar. We've talked about some of the basics around inheritance tax works. We talked about trust arrangements, gifts and allowances, as well as insurances. So how do you make the right decisions in relation to inheritance tax planning? Well, we can provide you with professional regulated advice and provide you with a personalized financial plan that's realistic and achievable, and that's based entirely on your goals. We'll also use financial forecasting software that will give you a clear picture of how your financial situation may evolve over the course of the rest of your life, taking into account inheritance tax along the way. We'll make sure that you don't pay any more tax than you need to, whether that be inheritance tax or indeed any other kind of tax. We'll look at the legacies you wish to leave for family, loved ones and charities and how that can be achieved. We'll also use the services of Quilter, which is a FTSE listed company, and they scan the entire market for us to find the best insurance, trust and investment options out there at the lowest possible cost to you. You'll also have access to a team of financial planners and wealth managers with hundreds of years of experience between them in advising clients. We also have dedicated tax support specialists for more complicated scenarios that we often come across. And we'll regularly meet with you to review your plans to ensure that your financial plan stays on track and, of course, make any adjustments that may become necessary, for example, as a result of legislative changes. So how do you get started? Well, we're able to offer an initial consultation with you, and we'll cover the cost of this. Usually we'll just arrange a 30 to 45 minutes call so we can get to know one another. We'll explain everything to you during the call, and if you don't want to take things further, that's no problem. If, however, you feel you'd like to work with us, we can then look at going through a more formal process, which will be explained to you fully before we start. So thank you very much for listening, and now we'll move on to any questions that you may have. Thanks a lot. For the questions, just for those of you who didn't hear at the start, if you just click on activities and click Q&A, you shall be able to type any questions into the box, and I shall do my best to answer them. Thank you very much. No questions yet, guys? Can also put them in the chat if that's easier. I've got one come in. How difficult is it to set up a trust? It's more the planning that goes on before setting it up that's the difficult part. Once you actually get to understand what kind of trust it is, then the actual setting it up part is fairly straightforward. It's just filling in some paperwork and getting signatures and so on. I think it's more about how you decide in advance the kind of trust that you'd like to set up. I've got quite a few other questions coming in. I think they are, yeah. What's the most commonly used strategy if over the inheritance tax limit? It's personal to you, Ian. I would say probably the most I've seen is combinations of strategies where people perhaps do some gifting, also do some trust work, some pensions, and some insurance. It's very rare that somebody just goes with one strategy. The only time I've really seen that is when it's insuring a potentially exempt transfer where they've given money away and they just want to insure that liability. Generally, it would be a multi-faceted approach, if that makes any sense. But it would be entirely down to you because people have different preferences. Eddie, are step-grandchildren covered in the family property? I'm presuming you're talking here about the main residence nil rate band. The 325,000 is applicable to every estate. Are step-grandchildren? I don't know is the honest answer, Eddie. I know that stepchildren are definitely covered. There's no doubt about that whatsoever. Step-grandchildren, I would imagine, if stepchildren are, then step-grandchildren also would be, because it follows that they are lineal, but you would need to get advice from a solicitor on that and get their opinion on it. Manjinder, will you send a recording link of meeting? Yes, we will. That will come out to you automatically for everybody that's attended. Nirupa, it's best we probably pick that up separately because you've disclosed some personal info there that I'm not sure that you would want me to share with the rest of the participants. So please, you'll get an email after this. Send me a reply, and I'll give you a quick call over the next few days to discuss that one. Yes, Ben. Yeah, it could be. So Ben is asking if somebody has an offshore bond, can it be reassigned to somebody else to avoid it being passed? They say yes, but it would be depends on that. It depends who they were, where they were, and all of that stuff. But I would say that that's going to then be a potentially exempt transfer because you're assigning something for money or money's worth. We'd obviously have to look at the technical aspects of that. And I don't have enough detail to give you a definitive answer, but yes, it could be done, but I would presume it would be a potentially exempt transfer. Jay, do I need to pay tax like capital gains tax in order to move property into trust? Yes, you probably would. Depends on what type of trust though and when. The other way to avoid that, the other thing about that, Jay, is you can create a trust within your will, and so that the actual property wouldn't necessarily need to move into trust It would also depend on whether it was your own property that you lived in or a buy-to-let. So probably a reason to have a consultation with us just to understand the details a bit more. Someone's raised their hand, I believe. Don't know if that was on purpose or not. No, let's go look. Mark, can trusts be set up through financial powers of attorney? Potentially. If you've got power of attorney, yeah, you could set up a trust for somebody else. Yeah, yeah, if they needed to. I think we've come to the end of the questions, guys. I can't see any others in there at the moment. If anybody else has some questions, please do ask. I'm happy to stay on for a few more minutes. Hold on a second. Let's have a look here. Have I done any work on understanding the Labour Party's view on BR schemes? No, I haven't been. I don't know what Labour's policy is on that. And one of the things I would always caution about is that pre-election promises are often not kept. So if they do have a policy on it, that wouldn't necessarily mean it would ever get anywhere should Labour get into power. So that's the best answer I can give you on that, Ben. Sorry. Okay. So I've got a few people leaving now. I don't think we're going to have too many more questions. So thank you very much to everybody that's attended. Anybody does want to ask me anything else, I'll still remain here for a minute or two. Hang on, have we got another one? No. David, possibly David, possibly have to assess the facts of the case. We do have somebody in house that can help. That's a specialist in this area in defined benefit pension schemes. Yeah, we'd start from the point of view that it would not be a good idea, but if then it emerged that they were, and I'm being very, very generic here, then I would say that it's worth probably having a discussion without answering the question as a yes or no. I think it's definitely worth you exploring it, depending on what those funds are. And I in the past I've been involved in cases like that where it's happened. So it depends on your overall situation, but it's definitely worth a conversation, David. Let's have another question. Manjinder, yeah, that's absolutely correct. So when assets pass from husband to wife or the other way around, no inheritance tax is due. That's absolutely correct. When it passes to the children, inheritance tax becomes due. That is correct. And it's payable within 6 months. That's also correct. Or rather, it's if you don't pay it within 6 months, you start to pay interest on it. It's not illegal or anything, but obviously you want to be paying it within that 6 month period to avoid interest accruing. Okay, guys, we've not got anything else coming in. So I think it's simply a case of ending the webinar here. Thank you very much to everybody that has attended and asked questions. It's an absolute pleasure. Look forward to hopefully meeting you again. Thank you very much for your all your time and your attendance.